Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, good morning, everyone. Show's called Your Money or Wealth. Joe Anderson, Big Al, back again. Thanks for tuning in over the next couple of hours. We got some interesting things on the docket today, so stick around. We're talking about financial planning. Imagine that. It's a financial planning show.
We are, yeah, true.
So that's what we're going to get into. First-time listener, thank you so much for tuning in today. You can go to our website if you'd like at purefinancial.com. Get more information about Big Al and myself. I'm a certified financial planner. Alan is a CPA. Alan's been doing this for, 32 years?
Yeah, I guess, let's see. I started my career in 1980,
80.
So that puts me about 36.
36 years.
Or almost 36.
Getting old.
Getting old.
Getting old.
But I started at age 2.
You did, huh? Got it.
I haven't hit 40 yet.
Yes. All right. Well, you know what? I didn't want to start with this, but I'm going to anyway.
What do you got?
I got this from Accounting Today.
Oh, really? You're perusing in my magazine.
Yes, I am.
You're a little bit skinny on material.
And this is just annoying to me. So this is Senator Ron Wyden out of Oregon.
Okay.
All right. So the headline said, Senator proposes crackdown on Mega-Roth IRAs.
Okay.
Mega-Roth IRAs.
Mega. What
the heck is a Mega-Roth IRA?
Something he made up. Does he define that term?
Yes, I'm going to get into it. But here's the problem, I think, with all of this legislation, sometimes when it comes to retirement plans.
Yeah.
They got to simplify the thing, first of all right? Because here's my biggest gripe, is that let's say that Alan works for a firm that has a 401k plan. I work for a firm that does not have a 401k plan. Okay?
Yes.
And let's say we work for you work for your firm for 30 years, I work for my firm for 30 years, and we make the same amount of money.
Right.
Right? Who do you think is going to have more money in retirement at the end of 30 years? Saved.
Yeah, that'd be me in my 401k, because I'm over 50, right? And if you're working 30 years, you're going to be over 50. So
but it doesn't necessarily matter, because the point is that out of sight, out of mind, directly into a retirement account through your paycheck.
Yeah, pay yourself first is the concept, right? And when you don't have a 401k, it's easy to say, I'll save whatever's left over. And guess what? Nothing's ever left over.
Nothing's ever left over.
Yeah.
And so, the facts are, people that do have a retirement plan through their employer will have more money in retirement. That's just the facts. That's what the numbers show. Yeah, there are some people that do not have a retirement plan that still save diligently, right? But then they have to cut a check. They have to send that check to the brokerage firm or the mutual fund company or whatever. And cutting a check is a little bit more difficult for some people than having it directly come out of their paycheck.
I'd say most, Joe. I don't know what the stats are, but I bet you maybe 1 in 10 has the discipline to do that. The other 90%, forget about it.
And if you would look at most, let's say, government employees, politicians, do you think they're really worried about retirement?
Not really.
Why?
Well, first of all, they got great retirement plans
pensions
themselves.
It's pensions, right? They have pensions. Government employees, right? State employees, school teachers, they have pensions, which is great. I'm not knocking that.
Sure.
But someone that's going to change the retirement landscape that doesn't really understand what the heck is going on, and then that person's going to have a cushy pension that's going to pay them, 80% of their high 5 years, is all of a sudden, we got to get rid of these Mega-Roths.
Yeah, because it's messing us up. We're not collecting enough tax dollars.
Yeah. And so it's like, no, all right, well, give everyone a fair shot. I'm all for fairness. So it's like everyone should be able to sock away $18,000 into a retirement plan.
Right.
Or, $24,000 if you're over 50 with the catch-up.
Whether your company has a 401k or not.
Right.
Right?
And so if I have to go to a brokerage firm, at least give me the opportunity to shelter $18,000. Maybe I can't afford it. Maybe I can.
Right.
Right. But if I can afford it, well, I'm going to do it. If I can't afford it, I'm not. Just like with someone that's working at an employee that has a 401k plan that's not even taking advantage of the match. How many billions of dollars are left on the table?
Yeah.
Because people don't save into their 401k plans for the match. I mean, there's a lot more problems than I think than an individual, a small group that all of a sudden have saved some money and now they have this Mega-Roth. Let me go on here, Alan.
Okay. Wow, this accounting today got you all riled up.
It did a little bit. So the draft legislation dubbed the Retirement Improvements in Saving Enhancements. So they're going to enhance our retirement scenario, this individual is.
Okay,
by
taking it away.
No, right. So he's going to crack down on strategies used by wealthy taxpayers to defer taxes by placing their assets in so-called Mega-Roth IRAs.
Okay.
There's no such thing as a Mega-Roth IRA. What did this guy... Well, here, maybe I can get my name
Sounds good in the headline
on Your
now.
Money, Your Wealth.
Right.
So let me talk about this. So his office points out to the figures from the National Retirement Risk Index that showed the average IRA account had only a little more than $25,000 in 2013. 25 grand is the average, 2013.
Okay.
And an estimated 60% of households had nothing saved in IRAs or 401ks at all.
Okay.
That's the issue, right?
Right.
So what the heck does a Mega-Roth IRA have anything to do with 60% of people haven't had anything saved?
Right.
Should I go on?
Sure.
I shall.
If I said no, would you have stopped?
No, not even a little bit. So according to a recent report from the Government Accountability Office, between 2,000 and 5,000 taxpayers had balances in IRAs, including Roths, of more than $5 million in 2011. How many people are in the United States?
300 million.
300 million. So you take 2,000 into 300 million is what?
It's a pretty low percentage.
Okay. So the estimated value of Roth IRAs totaled between $8 billion. So there's $8 billion in Roths. How much money are in retirement accounts, Alan?
In total?
Total.
Total? What? 24 trillion?
24 trillion. And so we got 8 billion in Roths. We got a Mega-Roth here, so we got to pull the plug on this.
Getting out of arms. It's
just
stop
getting out
the
of hand.
presses, everything.
All right. Well, first of all, to get money into a Roth IRA, you have to pay taxes. So you already got your taxes, right? And so if they're doing conversions, they're paying a bunch of tax to get that money into a tax-free environment, so it will forever grow tax-free.
Yeah.
So it's not some Ponzi scheme that people are, monkeying around here. The code is clear.
So does he talk about that? Actually, we like it when you do Roth conversions because you pay us a lot of money.
So taxpayers, and this is quote, okay, taxpayers are pouring dollars into incentives for retirement savings, but still far too many Americans struggle to set money aside after they cover their basics. That's what he says. I agree with you 100%. But tax incentives for savings ought to be available to more working families and more generous to middle class. Okay, agree with that?
Yes.
So what's the solution here, buddy? All right?
Getting rid of Mega-Roths.
Get rid of Mega-Roths. No, it's like, all right, well, even the playing field for all individuals. I'm all for fairness. More fairness means the economy will grow, and I get all of that, right? But I digress. Tax incentives, okay? So, and then he goes on to say a lot of recent college grads are buried under thousands of dollars in student debt, but paying down your student loans shouldn't mean you lose to the opportunity to save for your employer match. Yes, I get all of this. So why does he now want to go here? So he wants to crack down on massive Roth IRA accounts, okay? Because they're built on assets from sweetheart inside deals.
Really?
Explain. What the heck is he talking about?
He's done an investigation on that, huh?
It's time to face the fact that our tax code needs a dose of families when it comes to retirement savings. Okay, or fairness, I'm sorry. Let's see. That starts with cracking down again on the massive Roth accounts. So he thinks there's like sweetheart deals. So tell me, Alan, you're a CPA for 36 years.
Right.
How do you get a sweetheart deal into a Roth IRA?
Well, it's just like everyone else, Joe. You got to pay tax on the money that you put in, and then based upon your own investment savvy, that's up to you. If you get some good investments in your Roth, more power to you.
Exactly.
What's wrong with that?
What's wrong with that?
Yeah.
If I'm a savvy investor, if I know what I'm doing, right, and I build a portfolio, because you can only put in $5,500 into a Roth, and that's due to income limitations. So it's about $194,000 is the max as a married couple, $132,000 if you are single. So for like very high income wage earners, they can't even put a contribution in.
Correct.
So if I'm in those tax levels, $184,000 of adjusted gross income, what am I in the 28% tax bracket potentially?
Correct.
So I can't put a contribution in, but I can do a conversion. There is no AGI limitations on conversions, correct?
That's right.
So if I do a conversion, I'm going to pay the government at least 28%.
Right. And
plus state of California, that's another 10.
Yeah.
So call it 40% on the dollar that I'm going to convert.
Yeah, and chances are you probably hit alternative minimum tax, Joe. You probably get up to about a 45% tax rate.
So the issue drew attention 4 years ago during the 2012 president campaign when Mitt Romney's tax return revealed that his IRA was between $18 million and $87.4 million. At one point, exceeded $100 million. I want to get back to this point. We got to take a break, but I want to get back to this point. So if I have $100 million in my retirement account, all right? So I'm Mitt Romney. I got $100 million I have a mega IRA.
Yeah.
He's blown himself up.
The government should be so happy about that.
So excited about that.
And we'll explain
it
after
is
the break.
so stupid. It's like, okay, well, here, he's got $100 million in his retirement account. Look at all these people that don't have any money. Well, Mitt Romney, he put money into his, right? He bought his own stock inside the company, right? Inside his retirement account, his defined benefit plan. And the stock increased in value. It blew up to $100 million. I'm telling you, that's terrible tax advice that he got because it's inside of a shell of a retirement account. And we'll explain it when we get back. Go to purefinancial.com if you want more information about us. Don't go anywhere. We're just getting started, folks. Show's called Your Money or Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money or Wealth. My name is Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's a CPA. Thanks for tuning in today. Talking about the senator in Oregon, Ron Wyden. He's coming out with a draft legislation dubbed the Retirement Improvements and Saving Enhancements. On one side, I agree what he says, that most people don't have any money in retirement accounts. We got to do something here.
Yeah, I think we all agree with that. But his solution...
It doesn't make any sense to me. So he's saying, hey, we got to cut down on these mega-Roths. So what
I'm sorry, go ahead.
What I guess the crux of it is saying you can't have more than $5 million into a Roth IRA. If you have more than $5 million, you can no longer contribute to the Roth IRA or convert to the Roth IRA. So that's basically kind of his punchline here, because that's going to solve the world.
Right.
Because if more people have more money in Roth IRAs, well, the IRS is getting their tax money up front when you put money into a Roth.
Sure.
So they're already getting their money. Right? Then I'm now making my dollars grow 100% tax-free. I think that's my right. That's what's in the law.
That's why they set it up that way.
Correct.
Right?
So now you want to cap me at $5 million because that's going to solve the world's problem, because now you cap me at $5 million. I don't think I'll ever come close to getting $5 million in a Roth, but I congratulate our clients that potentially have the opportunity to do that.
You need a sweet insider deal.
Yeah, I know.
As the article says.
It's like, what the heck? He's like, oh yeah, these little sweet insider deals that people are doing to get this $5 million out. Sweetheart deals, inside deals. Stupid. Okay.
Now, did you say, Joe?
Yes.
So he quoted Mitt Romney as the problem, and Mitt Romney's money is in a regular IRA.
Right. So this all stemmed in 2012 when, he had to release his tax returns and things like that in his financial statements. And then and I guess they didn't have the statement.
Yeah.
They guesstimated based on how they came up with it, of how much money potentially he had in a retirement account.
Right.
And he said, well, it was somewhere close to $100 million.
Okay.
All right. Well, Mitt, congratulations, you got $100 million. But it's in a retirement account. The IRS, the government, should be saying, perfect.
We love you.
We love you, Mitt. Thank you for doing this. And here's why. Because if he owned that stock, right, or whatever stocks that he held inside that retirement account that gave that much appreciation, because you had to have a ton of growth in that stock, because there's limitations of how much money that you can put in retirement accounts.
You can't contribute anywhere near that.
It's not like, here, I'm going to put $1 million in a retirement account this year. No, it's nowhere near that.
Yeah, the upper end, Joe, that I've seen is maybe $250,000, and that's for certain defined benefit plans when you're like 70. But, I mean, and everyone else is contributing a lot less.
Pennies, fractions of pennies than that. So what happened is that maybe he put in, let's say, a few $1 million over several years, okay? But the investment that he chose to invest in had significant growth.
Sure.
Right? A huge compounded rate of return that was growing tax deferred. Now he's got $100 million sitting in a retirement account. This guy should be saying, perfect.
We love it.
And here's why. Because it's all taxed at ordinary income coming out. Every single dime of those dollars are going to be taxed either through Mitt's life, his wife's life, or the kid's life. They will get killed in taxes.
Right.
Because at age 70 and a half, you have to take a required distribution. All right? 4%. 4% on $100 million?
Yeah, $4 million.
That's a big dollar figure, right?
Yeah, and federal and state tax rate, let's call it a $2 million tax.
Right, half, for sure.
Mm-hmm.
Let's say, Alan, he had that particular investment outside of the retirement account.
Right.
Okay? So then it grows. Let's say he had the same significant growth. If he sold it, right? What's the tax?
Yeah, now you're talking capital gains rate, right, between federal and state. Even at the upper levels, Joe, it's probably no more than 34-35%.
It's almost half the tax of ordinary income.
Yeah.
Right? So it's like, well, would you rather have that type of growth outside of the retirement account or inside the retirement account?
Well, and the other
as
thing,
an individual, as a planner, as an advisor, no, you want that outside of the retirement account to take advantage of capital gains laws.
Of course, and you don't even have to sell, Joe.
Right.
In fact, if it were outside a retirement account, you could go your whole life without selling, live off the dividends, and then when you pass away, there's a full step up in basis, so your wife or your kids get it, and then they sell it, they pay no tax whatsoever. Now, that it's stuck in an IRA, that is so good for our government and such poor tax planning for Mitt Romney, because no matter whether it's him, his wife, or his kids, he's going to have to pay ordinary income tax on those dollars. And ordinary income tax right now is about 40% federal. State of California can get up to 13.3, and then there's all kinds of other little things that happen. But let's just call it a 50% tax. It can be more. It can approach 60% in certain cases. But anyway, that's what's going to happen. And if that's the issue that's causing this bill, it's completely misaligned, because that is actually a perfect storm for the IRS and our country, because we're going to get all those tax dollars.
Correct. And so if you are ever listened to the show, Al and I have been talking to you about, all right, well, here, you might be sitting on a tax time bomb. I hope Mitt should be listening. Right.
Yeah, or his advisors.
Right.
Listen up.
Right.
But I would say, Joe, it's too late for Mitt.
Totally.
I mean, so here's the strategy. Here's the correct strategy, in case you're wondering. So now Mitt should have done Roth conversions. Now maybe when he had this money, see, there was that adjusted gross income limitation, and he couldn't. But let's just go with current law. Current law says that anybody can do a Roth conversion at any income level. So let's say he takes a couple $1 million and takes it out of his IRA into Roth, and he's got to pay tax on the couple $1 million. But then his investments, whatever they may be, then they grow tax free, and then let's just say it goes up to $20 million. Let's say it's a 10-bagger. It goes up 10 times. All of that is tax-free. And you know what, Joe? And I agree with you. I mean, more power to him. I mean, this is the American dream. You can invest in what you want to invest, and if you happen to hit well, then that's great. But when you make big returns like that, you got to take a lot of risk, and it's actually more likely that your investment will probably go down to zero. So there was a lot of risk there, and it paid off. And had it been in a Roth IRA, Mitt and his family are sitting pretty. But now it's all in a regular IRA, all going to be fully taxed at ordinary income rates, whether they want to withdraw the money or not, because of the required minimum distribution rules that start at 70.5.
Right, and then he dies, right? Let's say his wife's still alive. So she's going to have to take a required distribution now on single taxpayer dollars, right? Or a single tax bracket.
Yes, even worse.
Even worse. Then they pass. Then it goes to the kids. The kids are going to have to pay tax. There's no way around the tax on these dollars.
And they have to start paying. They have to start withdrawing right away.
Right away.
They can't wait till 70.5. When you get an inherited IRA from your parents, well, you have to start taking a required minimum distribution at your current age, even if you're 10 years old.
So then here's along with cracking down on these Mega-Roths, the draft proposed would enable employers to make matching contributions to a 401k retirement plan while the employees make student loan repayments. Does that, I mean, the person still has to put dollars in the 401k plan to get the matching. Why would that?
How does that change?
How does that change anything?
How do you pay up your student loan and contribute if you don't have enough money?
Right. Okay, you have a 401k plan, they're matching. I'm paying my student loan payments. I can't put in the 401k plan. So I would therefore not get the matching. So they're saying now employers have to match even though they're not contributing to it? I don't think this individual knows anything about retirement or retirement planning or what the law states when it comes to these retirement plans.
Apparently not.
So also, I'm going to get into one last thing when we get back. But I'm telling you, things are going to change, right? Because we got politicians, and I'm not going to get political. I guess I already did. But there's individuals, I think, that are looking at some of this stuff when it comes to our retirement that they could say, you know what, no more Roth IRA conversions. There's something in the law that's probably going to get rid of backdoor Roths, stretch IRAs, net unrealized appreciation, some phenomenal tax planning tools that all of you should be taking a look at sooner than later. We have an election this year. Who knows what's going to happen in November, and who knows what's going to happen thereafter, right? We all know that, right? We have trillions of dollars in debt. We're running a deficit. They need more taxpayers. And if they start going after people's overall strategies to put themselves in a better position following the tax law, we got to take another break. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. The show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's a CPA. Thanks for tuning in. Join us on iTunes if you'd like at Your Money, Your Wealth right there on iTunes or wherever else you get your podcast. Devices. But we do have a podcast, Your Money, Your Wealth. Check us out there. You can go online at purefinancial.com to get more information about us. I was going to spend about 5 minutes on this, Alan.
Okay.
But now we're in segment 3. And I just have to explain what issues.
This got you going
It
today,
doesn't,
doesn't
because
it?
it doesn't make any sense. Doesn't make any sense. All right, so this is going to be the last. I'm only going to spend a couple more minutes on this. But I want to encourage people, I think, to really pay attention to what the heck is going on, especially when it comes to retirement, right? Because here's what politicians do. And since everyone's kind of all politic rallied up, is that, they say a bunch of stuff, but it doesn't really mean a lot of anything, right? And it gets the heart going, it gets you all passionate,
Sure.
gets you fired up, and things like that. But then what's the solution, right? In the solution, there's really no talk about, oh, yeah, we got to take care of that. We got to take a look at this. Oh, yeah, whatever. There's nothing really concrete when it comes, well, check my website out.
Right.
You know what I mean? Oh, yeah, that's on my website.
Yeah. We are going to fix this.
Yes.
How?
How are you going to fix it? Well, look at my website.
I can't tell you. It's top secret.
But you can go on my website. All right. So all of you that are listening to this show, this podcast, probably have more sophistication about finances than most, or else you probably wouldn't be listening to a podcast that talks about money for
Probably,
2 hours.
The rest of them would be listening to a fiction book or
Sure,
something,
right.
which isn't necessarily bad.
No, books on tape. Love
Yeah,
them.
but sometimes you got to get educated.
So, all right. So this individual, Senator Ron Wyden, nothing against him. Don't know him. Never met him. I'm not from Oregon.
Yeah.
Right? Whatever. But he's coming. It's a draft. This is not law.
So it's a bill that
It's a bill, and it made it to accounting today, so it must be worth something. So he's called RISE. It's the RISE Act, too. Retirement Improvements and Saving Enhancement.
they already got the acronym.
RISE.
Yeah,
Rise up.
It doesn't matter what's in a bill if you got a good acronym.
So what they're trying, then the whole caption that got me going was like, he wants to crack down on Mega-Roths. Okay, what's a Mega-Roth? He doesn't want more than $5 million in Roth IRAs. All right? Well, I think most of you listening probably don't have anywhere near $5 million in a Roth IRA because we've met with you. We're working with you. We've been helping you try to get to that $5 million mark, right? But most of you have most of the liquid assets in your normal 401k retirement plans. IRAs, 401ks, and the like that are going to be taxed at ordinary income. We're trying to help you avoid the tax time bomb later by slowly getting money into Roth IRAs so you never have to pay taxes on those dollars again. You don't have to pay tax your spouse or your children if you have children or your heirs. Then so a part of this conversation was like, well, there's a lot of people that don't necessarily have anything saved for retirement. Alan, I agree with that 1,000%. And we encourage you just to start something, right? Just start somewhere. It's never too late to start. But then he's like, well, there's a lot of recent college grads paying off a lot of student loans, right? So we got to help them out. For sure. I totally agree. But I don't think he understands how plans work. So he's like, well, if someone's paying off their student loan, they shouldn't be able, to miss out on a company match. What does match mean?
Last I knew, Joe, it meant that you put $1 in and your company matches it. That's the whole point.
Correct. It's a match.
So now if you don't put $1 in, he wants the company still to match. Is that correct?
Well, no, it's like, all right, alongside here, okay, under the proposal, recent graduates who cannot afford to save money above their student loan repayments would no longer have to forego the employer match.
So he does want the employers to make the match.
So then it's not a match.
Yeah, it's right. It's
compensation.
It's a pension contribution is what it is, and then of course, what's the definition of they can't save above their salary? Everyone's going to say that,
right?
Oh, sorry, I spent every dollar.
Right, I'm going to go back to school. I would much rather spend my money to sit in a classroom or an online course so my employer can match me. That's what I'm going to do. Oh, man. All right. In addition, the bill would eliminate Roth conversions for IRAs and employer-sponsored plans to prevent taxpayers from getting around the income limits. So that could mean a couple of things.
It could.
That could mean, all right, no more Roth IRA conversions. I don't think I think that's probably the backdoor Roth.
Yeah, I suspect that is what he's talking about.
But does he know?
Because there is no AJ limitations on a conversion.
Correct.
So
because you're paying the tax.
So there's nothing to get around.
There's nothing to get around here. Unless you do a backdoor Roth contribution. That is putting money into an IRA first. Because you're over the income thresholds, you can't take the deduction.
Yeah, and that's a contribution. Now, conversions are different, and a lot of people get confused. Contribution is if you have earned income if you're working, and you can put $5,500 into a Roth IRA or $6,500 if you're 50 and older. But if you make too much money, you can't do that anymore. And that completely phases out at $193,000, I think, for married, and $132,000 for single.
Now, does this make any sense to you?
Okay.
It would also gradually increase the age at which retirement plan participants would need to begin taking distributions from their retirement accounts. Wyden's office pointed out that the required minimum distribution age of 70 and a half has remained unchanged since the early 60s. It can't be the early 60s because retirement accounts were under ERISA in 1974.
We didn't even have IRAs until
we didn't even
after
have
that.
IRAs. God. The draft specifies that IRA participants who reach the required age with balances in their retirement plan less than 150 would not be required to begin taking distributions. So there's two things here.
Okay.
They're saying, 70 and a half, well, man, we haven't changed that since the 60s is what they're saying. In the 1960s, come on. At least do a little research here.
Right.
But if I'm pushing out the age, so let's say I don't have to take it at 70 and a half because they haven't changed the law, what? So now I can wait until 75. Who's that going to help? It's not going to help the IRS.
No, and the people that have less than $150,000 in their account, they want to take it as soon as they can.
They're going to spend it.
They need it.
They're not going to have anything in there. It's like, I got $150,000. That's all I have. I've less. I got $40,000.
Right.
I'm spending that 40 because that's all I have.
I'm out of money at 68.
There you go.
All right, Joe. Well, this does bring up a good point, though, and 'tis the season to look at your Roth conversions from last year. Because if you have extended your tax return, or even if you have not extended your tax return, maybe you did your tax return in April and you did a Roth conversion last year, you're allowed all the way till October 15th to re-characterize that amount. And why would you want to do that? Because you do your Roth conversion, why would you want to undo it? Well, in some cases, when you do a Roth conversion, the investments that you picked weren't very good, and so they went down in value. So you converted $100,000, now it's worth $70,000. Do you want to pay taxes on $100,000 when your account's worth only $70,000? Probably not. So you want to recharacterize that $70,000 back to an IRA. It's as if it never happened. You have till October 15th. Others of you, if you've been listening to this show, when we've told you about Roth conversions and you've done the math, you've done a tax projection, you figure, you know what? I can do a $100,000 Roth conversion, but I'm going to do two different ones. I'm going to do one $100,000 conversion. I'm going to invest those in stocks, and I'm going to put the other $100,000 and put that in safety, maybe like government T-bills. Now I'm going to wait until about this time and see which one has performed better. And the one that's done better is the one that I want to keep, and the one that has done not as well, I can recharacterize, no harm, no foul. You can do that each and every year, but you want to be able to get that done, because if you don't recharacterize now, by October 15th, you got to pay taxes on that.
I'm telling you, there's a lot of things that you want to make sure that you take a look at, right? We're coming into the fourth quarter, right? Summer's gone, Labor Day's gone, and hopefully you had fun at the beach. But now it's time to get serious about your finances. There could be some significant changes. I don't know. But wouldn't it be good if you didn't have to worry about, there's all sorts of different types of risks that we have to worry about. But now we got political risk, right? What's going to happen with our taxes? What's going to happen with our retirements? Are they going to change the law on us? Make sure that you understand everything. Because if you could imagine your retirement game plan that was no longer about a number or just about your investments. I mean, imagine if you could fill in all the gaps and have all the answers to a rock-solid retirement game plan that filled everything, covered everything from A to Z. That would bring you a ton of confidence, I'm telling you. 5-7, got to take a break. Show's called Your Money or Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money or Wealth. Joe Anderson here, certified financial planner. I'm with Alan Clopine. He's a CPA. Go to purefinancial.com if you want more information. There's a lot of good stuff on our website. If I do say so myself, that's a little biased.
Sure, but I agree with you. Of course, it's my website, too.
All right, what do you got? We'll get out this.
Oh my goodness! Well, that was kind of fun to go over those other things, but I've got, I guess, to continue our tax talk. I've got 6 reasons to do a Roth IRA conversion in your 50s and 60s. And Joe, how many times have you seen in national publications people say, you know what, when you hit your 50s and 60s, it's too late for Roth conversions because
most professionals
you should have done that in your 20s and 30s.
Well, you got to be young to do a Roth and everything else.
That's the crossover, the break-even point and all that. It doesn't work out. Well, here's 6 reasons. I want to go through these with you, see if you agree or disagree. And I think we can probably add about 10 more.
Right.
But here's the first one that is brought up. This is in bankrate.com, recent article. If you want to leave a legacy. Joe, if you want to leave a legacy to your children, grandchildren, one that will help them pay for their own retirement, a Roth IRA can be stretched to meet their goal, meet that goal. Your heirs will be required to take tax-free distributions throughout their life, but that isn't necessarily a bad thing. They get an annual tax-free bonus to remember you by, and there should still be plenty left when they reach retirement age.
Well, it depends on the balance of the account.
Sure.
It
Well,
depends
plenty.
on how much that they...
Yeah, $1,000.
So, yes, here, let's explain the stretch because this could be going away too.
It could.
And there's strategies to preserve the stretch. So we can get into details on that once we get a little bit more clarity on what's going on. What the stretch is this, is that if you pass away with a retirement account, the IRS wants their tax money. So
Yes.
It's a retirement account. That's what it's made for. It's for your retirement, not necessarily a legacy play.
Yes.
So when you pass away, it will go to your beneficiaries, your named beneficiaries, right? And this is non-spouse. So your spouse has different rules. So if you're married, your spouse can make it into a stretch IRA, or the spouse can put it into their own account. There's pros and cons to that. It really depends on the age of the spouse. If the spouse is under 59 and a half, it probably makes sense to keep it in the deceased's name because then the spouse can take distributions out of the inherited IRA or stretch IRA without the 10% penalty. If they move it into their own account, then they would have subject to the 10% penalty rules until they turn 59
if
and
they
a half.
need the money, right? Yeah.
So if they're over 59 and a half, right, then it probably makes sense just to consolidate the accounts, right, in my opinion, right? You could keep it in the other account, who cares, but it probably makes more sense to manage it just by having it into one account. All right, so they can commingle, but the non-spouse cannot, right? And the reason for that is because the IRS wants a requirement, a distribution out of those accounts at your passing. They want to recycle the money. They want to get their taxes. So if you pass away, it goes to your child. The child then has to take a required distribution based on their life expectancy. So if the child is 5 years old, 50 years old, 60 years old, it doesn't matter. They have to take it right away. They don't get the luxury of waiting to 70 and a half. 70 and a half required distribution is based only on the owner, not the beneficial owner, right? Because if I die with an IRA, I'm still really the owner. Then I have a beneficiary designation or a beneficial owner on that account because I'm still on title if I pass. So what the stretch does, instead of, let's say it's $1 million, right? Alan's my beneficiary, I die, Alan receives that $1 million. If he takes it all out at once, which he can do, but that would blow Alan's tax bracket wide open.
Yeah, so it's like I got $1 million raise all in 1 year. So now I'm in the highest tax bracket.
You got it, and you would lose half of it to taxes.
Right.
Or Alan could say, you know what, I'm 55 years old. I'm going to take a distribution based on that life expectancy. So he would take about 2% out of the account per year, right? And it would increase each year as he ages.
Right.
Well, all right. Well, here, 20 grand versus $1 million is not necessarily going to blow up Alan's tax return. So that, right, so he only has to pull out a very small portion of that while the other dollars are still growing tax deferred. So it allows the deferment or the stretch, if you will, of the taxation of that retirement account over that person's life expectancy. That's the stretch. Now, the latest budgets that we've seen, they're trying to eliminate the stretch.
Correct.
Is that they're saying, no, we want to have all of those distributed out to the non-spouse beneficiaries within 5 years. Okay. And again, like I said, we have planning techniques to preserve the stretch. It gets a little bit more complex. It has to deal with trusts, and we can discuss that another day. But what she's saying, or this article is saying, hey, you know what? You can leave a legacy by the non-spouse being able to stretch out that tax liability.
Yeah.
If it's a Roth IRA, they still have to take a required distribution. Roth IRAs do not have a required distribution to the owner. But again, if I'm a beneficial owner, it doesn't matter what type of retirement account it is. If it's an IRA, 401k, a SEP, a simple, whatever, profit sharing, they will have to take that requirement based on their life.
Right. So we definitely agree with this strategy, and you're right, Joe. It's a way to create a legacy and have it be tax-free, but you've got to get the money into the Roth in the first place.
Right.
Second reason to do a conversion in your 50s or 60s is you will face high required minimum distributions in retirement. This is probably the most clear one we see over and over again. Case in point, hypothetically, but this is a hypothetical case that I met last week. And so here we go. We got husband and wife just recently retired, 67 years of age, both government employees, right? And they both just started receiving their pensions. Their pensions are roughly 80% of their salary. So when you add those up together, they both were responsible positions. They're doing pretty well. They're in the 25% tax bracket. Let's just say their income is about $150,000. Just make up a number. But then you look at their IRAs and their 401ks and their 403bs. They got $2 million in those accounts, right? And so when they hit 70 and a half, so let's call it 3 years from now, 3.5 years, whatever it may be, then they have to start taking required minimum distributions, roughly to the tune of about $80,000 on top of the 150. Right now, their income is about $230,000 and growing each year. And by the way, they also get Social Security because they both worked in private industry before being government employees. So now we're looking at about, well, let's call it about $260,000, $270,000 of income. They're subject to alternative minimum tax. Their required minimum distributions, because they live in California, because of alternative minimum tax, are going to be taxed at about a 45% rate. If they convert today, they're going to be roughly a 35% rate between federal and state. That's a bargain compared to where they're going to be. They want to get as much converted in the next 3 years. In some cases, Joe, we see people that they're retired, they got money to live off their savings, they don't have to touch their IRAs, their taxable income is zero. Wonderful candidates to do conversions. Fill up those brackets while they're lower so that they can, when they hit the RMDs, they won't have to have as much in the higher brackets.
Right. I mean, it's always, you got to look forward here. You got to do some planning to make sure that you take a look at, well, not only today, but in the future, what's going to be the tax liability.
Yeah, no doubt about it, Joe. And I think, boy, Roth conversion, such a powerful thing. When you're talking about a Roth conversion, you got to do those in the calendar year, right? You got to do it by December 31st. And so now is the time when you ought to be looking at it. Actually, you should have been looking at it before, but if you're just hearing this message, get your ducks in a row right now. Figure out how much Roth conversion is going to make sense for you. There are strategies, whether you're working or not, to be doing these conversions right now so that you get the right amount in before year end, because it's all about taking control of your taxes in the future. And I got to tell you, people that I talk to, a lot of people don't think they have any control over how much they pay in taxes in retirement, but it's simply not true. And you may not be getting this advice from your current advisor or even your CPA, because their job is not necessarily to save you taxes throughout your retirement. And in many cases, it's not really their expertise. There is a way to do this, though, and that's to do some forward-looking tax planning, have a forward-looking tax-efficient strategy.
All right, we got to take a break. Show's called Your Money, Your Wealth. We'll be back in a second.